Okay, good morning, everyone. Welcome to the investment meeting for September 2011. Let me turn it over to the chair.
Good morning, everybody. Let's go around. I'm Andy Schaefer, representing Commissioner Kelly.
Barry Dennis, SIS.
Joe Alejandro, PBA.
John Grasso, PBA.
Bob Ganley, SBA.
Lou Turco, LBA.
Chris Monahan, CEA.
Michael Palladino, DPA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
Barry Miller, Controller's Office.
Thad T, Controller's Office.
Seema Himrani, Controller's Office.
Martin Ganson, Controller's Office.
Larry Schloss, Controller's Office. Rob Goldrich, Mayor's Office.
Lisa Chan, Moby Office.
Janice Emery, Office of Finance.
Inga Van Eysden, Law Department.
Kevin Holleran, Police Pension Fund.
Kevin Davis, Controller's Office.
Rhonda.
Ken Narrow, Pension Fund.
John Como, Pension Fund.
Liz Caldas, Controller's Office.
Kathy Martino, Controller's Office.
Bob Senske, State Pension Fund.
Okay, good morning, everyone. We're in the public session. I'll turn it over to the controller. Larry.
Just 1 second, a point of personal privilege here. We are going into the 10th anniversary of September 11th in 2 days, and I would just like to take a moment to remember those that we lost, not only police officers, but firemen, first responders, and also the civilians who lost their lives on that day. So I would like to take a moment of silence to remember all of those individuals and all those who are still suffering the effects of 9/11. So just a moment of silence, please. Thank you.
I think we'll start today with a review of the year, since the June 30 fiscal year ended. Martin, do you want to go through the city pension fund first, or the police pension fund first?
Yes. So I'm going through the police pension fund book for the quarterly report. And in sum, the June quarter ended roughly flat. The U.S. equities was up about 1% for police pension fund, right in line with benchmark, which if you turn to page 20, you'll see the numbers. But the really good news is that on the fiscal year to date, which is, by the way, throughout this book, the same chart as the trailing 12 months, as the year ending June, the return was 23.26. That return is one of the strongest returns we've seen in decades for the retirement system. And so you should be very pleased about those numbers. In the year, the Russell 3000 was up over 32%. That's U.S. equities. Non-U.S. equities were up about 30%. In core investment grade fixed income, returns were up about 4% for the fiscal year. High yield, we've been talking about that a lot, has finished strong, up about 14%. In other words, the returns for the year ending June were very good. We'll be going through a little bit later, July and August, but for June, the returns were very strong, as you see on page 20. And in fact, the strong returns that you see for the fiscal year brought the returns for the longer periods of time up, and those include the down markets in 2008 and 2009, so those numbers are now positive and in fact near 4 and 5%. Page 21 shows the asset allocation in the pie mix. The pie is starting to become very busy, and that's because of the diversification of the assets of the fund. The bottom part of the pie shows the over and underweights, and I do want to point out that the over and underweights are versus the old asset allocation. In a little while we'll go through what those look like versus the new asset allocation, because back in July the board adopted a new asset allocation. Under the old asset allocation we were overweight U.S. equities and underweight, we were underweight real estate, private real estate, and underweight EFA and overweight emerging markets. Those numbers will change, as Larry will show you, in the new asset allocation in a few moments. The next few pages go through attributions of returns, but I do want to draw your attention to page 26. And if you look in the middle of the page, towards the right, it shows the year ending June 11. I mentioned it was over a 23% return, and the number in parentheses shows you where you ranked versus other large public funds. In this case, the fund is greater than $10 billion, and you ranked well into the top quartile. So the numbers were very good, not only on an absolute basis, but also compared to your peers. The returns for the prior fiscal years were near median. If you turn the page, you'll see what the annualized numbers are, and again, 1 year in the top quartile, and going out for 3, 4, 5, 7 years, 10 years, you're actually below or better than the median return. And for 15 years, right around the median return. The equity analysis starts on page 29, and I'm going to turn it over to Sue.
Thanks, Martin. If you turn to page 30, this shows the domestic equity returns, and you can see for the quarter, the fund just trailed a little bit behind the Russell 3000 index. And the way that those returns are broken out, you can see on the next page, 31. And just a couple columns to point out the index return, the actual return, and then the difference. The two ones that I would highlight here would just be in small cap active, where you've shown some outperformance of about 80 basis points. And then on the small to mid, that's the SMID cap active, underperforming a bit there by about 180 basis points, which would include Times Square and Security Global, both a growth and a value manager. But on the small cap active side, Brown, which is one of your developing managers, did well, as did Dalton Grenier, which is a value manager in small cap. And then I just point you to page 38, and we can go through the international allocation. This pie chart just shows where the money is by style, and also by emerging markets, which is the blue piece of the pie. And as you might remember, we've been growing that as planned, as per the new asset allocation. So that number is up close to 27% now of the total. If you turn to the next page, 39, this shows the EFA market returns versus the index, and the blue bar there, which is the active managers, they trailed a little bit behind the benchmark. Mondrian, though, was a highlight there for you that did very well in the quarter. If you turn to the next page, which is emerging market equities, so again, trailing a little bit behind the index there for the quarter. And DFA and Bailey Gifford were part of the contribution to that, but longer term, these managers have both done very well for police. And now I'll turn it back over to Martin.
So your fixed income allocation is shown on page 43. It was, as of June 30th, 32% of the total fund, or $108 billion. The green part of the pie chart shows that the largest allocation is to the investment grade program at more than 57%. If you turn to the page following, you'll see a breakdown further of the investment grade program. And if you look at the column, the column that's labeled over and underweight in the table below, we were underweight the Treasury agency sector, also known as the government sector, and overweight mortgages. In the difference column, you'll see we were slightly underperforming by about 7 to 19 basis points in those sectors. The investment-grade credit managers were flat to the benchmark. The program as a whole is shown on page 45. 19% of the fund is invested here, and that's $4.6 billion. The quarter was a relatively strong quarter because yields went down, therefore prices went up, and treasuries did best. The return was 2.42, but importantly for the year, the return was 5.12, very strong against the benchmark, nearly beating it by 100 basis points. The good news is, going out through the program back out to 15 years, the returns are generally in the 7% range and ahead of the benchmark. I also want to draw your attention to the table below that shows the volatility of the program. And so you've earned the 5, 6, 7% returns with about 4% volatility. TIPS returns are shown on page 46. And here they're largely driven by the fact that these are Treasury securities. Rates went down. In the case of TIPS, real rates went down. And so you have strong positive returns for the quarter as well as for the year. For the year, it's 7.21% behind the policy benchmark of 7.74. We have positive returns out till the inception date of 6 years ago of 5.56, which is ahead of the benchmark by 12 basis points. Strong returns are shown for enhanced yield or high yield managers on page 47, about 1% for the quarter, but very strong 15.48 for the year, and that's 88 basis points ahead of the benchmark. For the 3-year number, I want to draw your attention to that because the 3-year number fully includes the downturn in 2008, and the return for that period is 11.40% annualized. So in the high yield market, the returns have fully come back from the 2008 lows. In addition, the returns going out to longer periods of time are very good in the either 8% range or upper 7s. Convertible bonds are on page 48. While the returns were slightly negative for the quarter, for the year they were very strongly positive at nearly 20%. They were behind the benchmark shown in yellow. We also have a 3-year record where we're a little bit closer to the benchmark. We added a purple bar because, as you know, it's come up before. We've been telling you that the managers are outperforming their benchmarks, but yet they're underperforming the overall benchmark, and that's the reason we built the new index to show you that if you take the weighted average of each manager's individual benchmark, they are in fact beating those benchmarks, and that shows that here. Over time, we would expect those benchmarks will converge. Time will tell. On page 49, we see opportunistic fixed income, and those are our strongest returns in fixed income. A little over 1% is invested today. This chart shows and reflects the new benchmark of 10%, as well as the secondary benchmark of global high yield plus a premium. Returns for the year very strong at nearly 24%, well ahead of the benchmark at 10% and well ahead of the high yield index plus a premium. Kathy Martino is here to talk about the ETI program.
Good morning. The ETI program, which is, as always, is shown at a fees, while it trailed its the 3-month benchmark, it did outperform for all of the longer periods, so your investments are performing as is expected. Your collateral benefits start on page 8 in the big package. I'll just give you one highlight, which is that the AFL-CIO Housing Investment Trust made a $134 million investment for the Penn South complex on the west side, which is 2,800 units of limited equity cooperative housing that needed major capital improvements, and it will keep that project affordable for at least the next 20 years. If there are any questions.
Hi, good morning. Just wanted to also give you an overview of the portfolio, the real estate portfolio performance over the past 12 months, as well as some highlights for the first quarter of 2011. There's been some encouraging signs in real estate over the past 12 months, notwithstanding what happened in August, of course. The recovery has been muted because the unemployment is not exactly where we want it to be. A little uneven, but transactions are happening. They are increasing. $170 billion worth of deals actually during the past 12 months, which is a 139% increase over what happened in 2010, where there were about $71 billion deals done. These transactions have been facilitated, of course, by lower interest rates and availability of credit that we hadn't seen in a number of years. Although there are stricter underwriting rules now, you still have the commercial banks lending, you still have the insurance companies lending. However, where they would issue senior loans at up to 75% loan to value, that's now in the 50 to 60% range. Also, the CMBS market, which at the height of 2007 had issued $225 billion worth of securities, has been active off and on this year. There have been a couple of deals that kind of fell down during 2011, basically because the rating agencies had some difficulties rating such issuances. But there are deals being done. The end of 2010, of course, ended with a major sale, $1.8 billion. Google took down 111/8 for its headquarters. We talked before about the interest in core properties, high quality, cash flowing properties in gateway cities like New York, like DC, like San Francisco. So investors are after those deals, including 8 of your core managers. Another subset where there is some opportunity, there's definitely some premium in yields for investors that have the skill set to fix broken deals, fix their capital structures, to reposition them, to do a little bit more leasing. And the police portfolio has 19 non-core managers that do exactly that. In terms of property types, all of the property types, apartments, retail, industrial, office, all during those 12 months had seen some uptick in terms of occupancy. Vacancies are lowering. I'm sorry, I just lost my train of thought. But overall, over the past 12 months have been good. However, things are changing. Definitely the S&P downgrade and other things have caused some uncertainty in the capital markets. So, we are cautious proceeding in the next 12 months. But in terms of the police portfolio, I'm happy to say that the year's performance was 26.1%, which was 710 basis points above the Odyssey benchmark. So the 12-month period, we were doing fine. As it relates to the first quarter of 2011, the police portfolio delivered a 3.5% return. The Odyssey benchmark was 3.8, so we're kind of closely matched up there. But again, as you know, the real estate allocation was increased in 2007 from 3% to 5%. So most of the heavy lifting that we've done in real estate have been in later years. So we're still kind of feeling the impact of the, of the J curve and some of the non-core opportunity funds that we committed to recently. So that will conclude my remarks. Thanks.
It was my understanding that 5% was not fully invested, that we had a lot of dry powder during that period. So
which leaves
the effects were not as dire on our fund. Right?
That's correct.
Next, I'm going to spend a couple minutes on private equity, do kind of the quick year in review as well as the quarter review, touch a little bit about the market. So if we look at the market today, deal activity remains strong. The number of larger deals in the market today, a larger deal defined as a deal greater than $1 billion, has increased over 50%. The number that everyone likes to hear and talk about is dry powder, so the amount of money that's sitting on the sidelines. At the end of 2010, there was $410 billion of dry powder. If we roll that forward to June 30th, that number has decreased now to about $390 billion. That being said, on the fundraising side today, there's about 650 plus funds in the market. It's the highest number ever recorded. And those funds are looking to raise today in excess of $650 billion. And if we look at the overall fundraising, 2010 was approximately $110 billion, which was down from the peak of 2007 of $560 billion. And if you look at the current pacing for this year with what's in the ground and what we're looking forward to, we're at about $141 billion is the expected number. As I touched on before, deal activity remains strong. A couple big deals announced. One was HCA at about $3.8 billion, Kinder Morgan at $2.9 billion, so big deals. But most importantly, the one I would mention is Nycomed, which is in Avista 2 and 3, which is a fund that the police portfolio is in. They sold Nycomed to Takeda Pharmaceuticals for an excess of $13.5 billion, so that's generated some nice distributions. If we touch briefly on the overall police portfolio, so just kind of looking back to the strategic plan and the allocation for private equity was 7%. Currently, the portfolio is at 6.7%, so very much in line with the allocation. If we look at the overall inception to date returns, 10.2% IRR, a multiple which is in the process of eclipsing 1.3, so clearly moving in the right direction. It's 135 partnerships, 96 GPs, so still an incredibly diversified portfolio. And if we look at the overall year-over-year return, doing in excess of 18%. So while all good numbers on an absolute basis, continues to underperform the Russell and is exceeded the benchmark for the private equity median and is kind of a little bit below the top quartile, but continues to move forward. Made 4 new commitments to EQT, BC Partners, AXA, and Pegasus. Those 4 commitments were in excess of $200 million. Last 2 comments I would make is one, with regards to the allocation of the portfolio, very much in line with the targeted allocation, roughly 70% buyout, this 10% venture/growth, and the balance is in the proverbial other bucket. And the last comment I would make has to do with the contributions and distributions. For calendar year 2010, contributions exceeded distributions, but the first quarter of 2011, for the first time, distributions exceeded contributions. So net positive cash flow, and it's roughly 1.2 to 1, so clearly moving in the right direction. Echoing a little bit of the comment Joe made about real estate, the portfolio is still relatively young. It's only about 75% called, so there is a lot of dry powder. So the first quarter, while distributions exceeded contributions, that number is going to continue to change as more money is put into the ground. And if there are any questions, that's private equity.
All right, so that's the year, up 23+%, top quartile, great job. This year's going to be a little more complicated. We'll get to that in a second. Let's first, Martin, do the VSFs.
So we'll start with police officers.
I'll need a copy of that because I didn't get one.
Thank you. I have one extra one if anyone needs.
I think I have to go out of session. Okay, make a motion that we leave executive session and go. What was that? Leave in public session to go into executive session.
Second?
Second?
Second, finance?
Fixed income is shown on page 17. The largest portion is the 4+5 investment grade program. That's shown in red. 31% of the assets are invested here. Page 18 shows the over and underweights as well as the allocations to the individual three sectors of that program. We were underweight governments and overweight mortgages. Both of those programs, their individual managers underperformed slightly. Investment grade credit outperformed by 4 basis points. Taken together, 4+5 on page 19, returned 2.29%, down 28, but returned a very strong return versus the benchmark for the year, beating it by 114 basis points at 529. And the return is generally in the 6 to 7% range with 4% volatility longer term. Tips are shown on page 20. The manager returned 3.43 for the quarter and nearly 7% for the year. Since inception, we have a 6.96% return, is just ahead of the benchmark. And finally, high yield on page 21 is the star of the fixed income program here. It's 5% of the assets, returns for 18.83% for the year, well ahead of the benchmark by over 400 basis points. And that brings the longer term numbers to very strong results. In fact, the 10-year number here is now over 9% just for high yield. Unless you have any questions.
I do. Martin, these return figures are net of contributions?
The contributions there are no contributions.
So there have not been any contributions this year?
That's correct.
And do you know when the last contribution was made?
I would have to go to Bob North, but I believe it goes back to the 90s.
Bob, do you have a more exact figure?
Sometime in the 1990s, I believe it was 1996.
So since 1996, 15 years, there have been no contributions in the city to this fund.
That is correct.
And it has managed to pay out what it is intended to pay out to the beneficiaries of the fund.
That is correct.
Okay. So no effect on the city's budget at all for this?
Not necessarily true. The actuary takes into account the expected value of benefits to be paid from this fund when developing the employer contribution to the main pension fund.
But it is an expected contribution on your behalf, so in essence a best guess, right? Which hasn't proven out in the last 15 years.
The mechanics of moving money between the main fund and the variable supplements fund is by complicated technical formulas.
It's complicated for this conversation.
Thank you. However, the funding of the main fund is designed to take into account the anticipation that such transfers of funds will occur and make sure that adequate funds are available to pay both the funds in the main fund and ultimately whatever else is necessary from the variable supplements funds.
But that assumption has not proven out in the last 15 years, and even though you have made these complicated calculations, the city has not been required in the last 15 years to actually make that contribution to this fund, right?
The city has been making contributions to the main pension
We're talking
fund
about the variable
in
supplement.
anticipation of what would go to the variable supplements fund, but no money has moved from the variable supplement to the variable supplements fund from the main fund under the particular mechanics of those rules.
So under a very long, erudite argument you made here, the city has not made a contribution.
No,
Okay.
I
Thank
wouldn't
you.
say that.
Okay, thank you very much.
I will add that we will be paying benefits to out of this fund for the December 15th payroll, consistent with market conditions and the asset allocation that's here now.
Thank you very much. Do we need to leave the
Yes,
public
we have a
session?
motion.
Motion to leave public session of the police officers variable supplement fund.
Second.
Second, control. Okay, now we need a motion to go
Motion
into
to go into public session on the Superior Officer's Variable Supplement Fund.
Second? Second. DEA? Okay, roll call vote.
Bob Gamble, the SBA.
Lou Turco,
LPA.
Chris Monahan, CEA.
Michael Palladino,
Larry Schloss, Controller's Office.
Rob Goldberg, Mayor's Office.
Janice Emery, Office of Finance.
Superior officers.
Okay, so if you turn to page 3 of the PSO VSF quarterly report for the quarter ending June, you'll see that the fund was valued at $419 million, and similar to the other funds, had a slightly positive return for the quarter, but very strong returns for the year, returning over 23%, bringing the longer-term results higher as well. The asset allocation is shown on page 4. It's a fairly simple asset allocation, all public markets, 60% in U.S. equity, and the balance in fixed income. And the allocations are roughly in balance. The equity portion is entirely passively managed, so you see that on page 10, and the results are on page 11, flat for the quarter, but very strong results, over 32% for the fiscal year, bringing the longer-term results higher, and this is 60% of the fund values. For fixed income, the allocation is shown on page 14. That's 39% of the total fund, or $162 million. The lion's share is in the investment-grade fixed income program, which is further broken up on page 15. We are underweight the government sector and overweight the spread sectors. The government and mortgage sector managers underperform slightly, and the investment-grade sector manager outperform slightly. The total returns of the 26% allocation to structured investment-grade fixed income is shown on page 16. For the year, returns are very strong at over 5.5%, well ahead of the benchmark, bringing the longer-term results to over 7%, and for 10 years, over 6%. High yield is on page 17, and similar to the POVSF fund, slightly positive for the quarter, very strongly positive for the year, over 19%, over 400 basis points ahead of the benchmark. Benchmark has been beaten for all the time periods shown, and for 10 years has returned over 9%. Are there any questions?
Bob, same complicated. So the Superior Officer's Fund is the Police Officer's Fund?
Indeed.
Okay, thanks.
And I do want to state also that we will be paying benefits for this fund for December 15th, and we will be reviewing market conditions to see where to take the money out from to meet those obligations.
Thanks, Mark.
Okay. You want to adjourn this and go back to the main fund?
Motion to adjourn
Sorry.
the Superior Officer's Variable Supplement Fund.
Second.
Second, okay.
Okay. You don't need roll call, do you? Yes. Okay.
Do we need a motion to get back into, motion to go back into public session of the police investment, police pension fund?
Okay, Martin's handing out the July numbers. Wait till I get them all handed out. That's Martin. Make it go? Okay. I'll be real short on the economy. If you all read the paper enough to know what's going on. So if you quickly flip to page 9, 70% of the U.S. economy is the consumer, and the consumer's getting bummed out. Okay? You can see it in these consumer confidence numbers. When it crosses below 50, we have a problem. It's now 55. Go to the next page, architectural billings. It's a leading indicator of all the building that's going on. We've talked about this before. You can see for the past, 7 months it's gone down. Again, below 50 is contraction, it's below 50. If you skip to page 12, existing home sales, going down. Next page, new homes. If existing homes don't sell, you don't need to build new homes. Going nowhere. All those things going down leads to unemployment stuck at 9% and up, and the president's trying to take care of that as of last night. If you jump to page 21, in the markets, this is a July report. All hell broke loose in August. You can see it in the VIX. The VIX in August is pretty much the way it was sort of in March of last year, if you can remember back that far. Both times of a lot of uncertainty and strife and volatility, and I presume that we're going to have this volatility through the presidential election. So that's a long time. So we should all buckle our seatbelts. I think the stock market's worried about the budget deficit, worried about slipping back into recession. The euro is a mess, not fixable overnight. So lots of volatility, lots of fear coming back out. If you look on page 22, the white line is the Treasury curve. You can see the collapse in the white line in the short end. And you can see they're going to slowly start, the Fed probably is going to start to work on the longer end. But if you flip to the next page, 10-year Treasuries. This is prepared middle of August. It's currently below 2%. 2% for 10 years really doesn't make a lot of sense, right? Think about just the concept of it. Doesn't make a lot of sense, but it tells you everyone is looking for safety and they're piling in here. If they're piling in here, they're piling out of the stock market. So they go back and forth and back and forth. Risk is off. Go on page 24. You can see the high yield market backed up dramatically in the last month or so. The good news is we sold half our high yield bonds last year, pretty much near the bottom. So that was good. If you go on the next page, the key line here is the blue line. The blue line is corporate profits. Profits are up. Stock values are down. PEs are getting pretty cheap. So at some point the stock market will go back up. But again, people are very anxious about which way the economy is going. If you look on the next page, page 26, the blue line is corporate profits overall. This compares coming out of a recession.
Larry, does this point to a potential problem with regards to our governance issues, with regards to executive compensation being based on stock value, and they're making quite a bit of money, but is that gonna come up and be reflected later on?
You mean in the board's voting of its proxies?
Mm-hmm.
Yeah, I think we'll ultimately, that the corporate governance and will review all the compensation plans and vote accordingly.
Right.
So yes, there'll be future meetings on that. On page 26, again, you can see corporate profits going up nicely coming out of a recession. So oddly, jobs are bad, partly because corporations are cutting jobs, so they're making a lot of money. They have a lot of cash, so the cash is being used for acquisitions and to buy back stock, pay dividends. So there's a lot of good stuff there. The problem is people are afraid to buy stocks.
And also compensation.
So if you look at the next page, 27, these are the PEs. The yellow is the forward, the black is the forward PE. So this is projected PE. So the top one is the Russell 3000, the second one is IFA, and the third one is emerging markets. And if you look at the numbers in these blocks, at some point these look really cheap, right? And we'll come back to that in a second. On the next page is the U.S. It's large cap, mid cap, small cap. Again, large cap stocks getting pretty cheap in here. That said, if you look on page 29, you see what happened in August. Pretty much starting August 1st, the stock markets are down. International stocks, particularly anything that looks like Europe, was probably down 10 or 15%. We're very worried about the banks in Europe. It won't be deja vu like 2008, but people actually do remember what happened in 2008, and they're very worried about it. If you look on page 31 then, you can see the police pension fund assets over the last 10 years or so. It was up and away. We had a great year, and it's pretty much, in this report, we're down a couple of percent in July. I presume we're down more in August. So we're starting the new fiscal year in the hole. You can see that more dramatically on the next page. You can see where we are now. If you look at asset allocation, as Martin was discussing, this first page, page 33, is the asset allocation relative to our old asset allocation. You may recall, I think it was in July or June, we approved new asset allocation. So again, we've been running the ship based on this asset allocation. The number that not most important, but extremely important is we did sell equities, I think it was in March, April, May. We also sold, as you recall, half our high yield bonds. We've done nothing with that money. So if you look over on the far right, we have $1.4 billion of cash. It's in short-term treasuries, actually. So about 6% of the fund is safe, put away, which is a terrific place to be from a risk management perspective because of all this volatility. That said, the homework assignment on the next page, 34, is to get from the asset allocation on 33 into this next one, which is new asset allocation. So we're completely out of whack, which is okay. We have time to get into new asset allocation. Again, the key components of that shift are less U.S. equities, less IFA equities, which we're working on over time. But again, we're going to try to work our way in and definitely wait until we understand which way the markets are going. So that's a work in process. But again, we don't have to sell anything because we have the cash. We're underallocated in private real estate. As we know, that takes time. And the big pink underallocation, opportunistic, we're very much in hand as to what the plan is, and we just have to execute on that plan. So this is really what we're going to talk about in the future. If you go to page 36, again, this is the first month of the new fiscal year, so the relevant column is the first column on the left. We're down about 1%, is the bottom line. Again, the top two colors, the green and the yellow, are the stock markets, so the stock markets were down. Excuse me, we made money in Core Plus 5 in the blue because rates went down, rush to safety, prices went up. So you net July, we only lost 1%. August was worse. We'll come back next month and tell you exactly how August worked. With that, the rest are all manager by managers. Seema, anything in equities?
No.
No. Martin, anything fixed income?
No, unless there are any questions.
Okay, so with that, again, we had great last year, dropped back 1% in July, and a lot of work to do with the fiscal year. Any questions on July? Perfect. We have nothing else for the public session.
Larry?
Yes.
I have one item for the, before we go out in public. I'd like to ask the law department, if I may. Inga?
Yes.
With regard to the securities litigation RFP, can you let us know where that is?
Sure. About a month or two ago, we renewed the contract of the current pool participants for 1 year. Our plan is to issue an RFP for a new securities litigation pool sometime in the near future to ensure that by spring 2012 we have a new pool established.
I'd like to ask at the next meeting, the law department provide a report to the board as to the release of the securities litigation RFP, and in that report include the expected date that the RFP will be released, as well as all the pertinent dates up to and including the expected execution of the contract.
Sure.
Thank you.
Any other questions for the public session?
Do we need to review that as a board? That RFP?
No.
And why? Should we have a copy of the RFP?
It's an RFP that I know that the law department does in consultation with our office, and would be pleased to keep the board updated on its progress, yes.
Yeah.
Joe, we will work off the old RFP and improve it in certain aspects to address issues that have come up with the current pool. But you're more than welcome to be involved in that process.
I think so. It's just, no, well, I'll let you know, but I think for purposes of transparency, we should at least have the review. But I'm not sure if anybody's interested in actually seeing the RFP itself. And, but I'll get back to you later on that to talk about it.
Is that all?
That's it.
That's it. So,
A motion to
motion to
exit.
leave public session and go into executive session.
Second? Second. Okay.